Welcome back to the show. Today we're doing something different, something deeper, because what happened to the crypto markets over the last few days deserves more than a surface-level explanation. It deserves proper context, it deserves clarity, and it deserves a breakdown that really gets under the skin of this entire move. Because from the outside, this latest drop looks confusing. It looks like it contradicts everything we talked about last week. It looks like the market has shifted direction overnight, and for a lot of people, it feels like a betrayal of whatever stability or recovery the charts were starting to show. But once you dig into the mechanics and the timing, it becomes clear that nothing about this drop was random, nothing about it was unexpected, and nothing about it changes the bigger picture for where crypto is heading in 2025. What happened was a perfect collision of two forces. Wall Street turning risk off at the exact same moment that Bitcoin ETFs flipped into outflows. And when those two signals collide during the lowest liquidity period of the month, Thanksgiving week, the market reacts in ways that look dramatic, but are actually mechanical. So today, we're unpacking the whole thing. How it started, why it accelerated, what role ETFs played, how tech stocks dragged crypto with them, why liquidity vanished at the worst moment, and most importantly, what this really means for the months ahead. Now, if you've been listening to the show recently, you'll know we've spent a lot of time talking about structure, about accumulation, about the early signs of a base forming. And those signs were real. The recovery signals were legitimate. Institutional flows were stabilizing. The market was starting to regain a bit of confidence, and the fear that dominated November was beginning to soften. None of that was misread. None of it was wrong. But markets don't move in straight lines. And the recovery that was forming last week was still sitting on top of incredibly fragile liquidity. The kind of liquidity that disappears instantly during a US holiday. That fragility became the weak point the moment Wall Street turned risk off. So let's start there. With Wall Street. Because people forget something important. Crypto doesn't exist in a vacuum. As much as the industry wants to brand itself as uncorrelated, decentralized, and immune to macro shifts, the reality is this. The market still trades like a high-beta tech asset. When tech stocks catch a cold, crypto catches pneumonia. And this week, tech didn't just catch a cold, it took a hard hit. Across the board, we saw major tech names pulling back. Risk assets got sold. Hedge funds reduced exposure. Portfolio managers rebalanced heading into December. And importantly, the Nasdaq broke its short-term momentum. That matters more than most people realize, because crypto trading desks, especially the institutional ones, use tech indices as their risk gauge. When the Nasdaq drops, those desks cut crypto exposure as well. It's a linked system. And the relationship has been tightening ever since ETFs launched. So tech weakness alone was enough to put pressure on Bitcoin. But under normal liquidity conditions, that pressure would have resulted in a mild, controlled pullback, not the sharp cascade we saw. What made this move so aggressive was the timing. It landed right on top of Thanksgiving week, the period where US liquidity collapses. Thanksgiving is a strange phenomenon in markets. Trading volumes drop, market makers reduce inventory, algorithms get turned down, retail is distracted. European desks pick up volume but not enough to compensate. And the crypto market, which is already more sensitive to liquidity than stocks, becomes extremely fragile. It's almost like the market becomes hollow. There's still price action, but the order books thin out. And when order books thin out, even small moves become exaggerated. That's exactly what happened here. At the same time tech turned risk off, Bitcoin ETFs flipped into outflows. And if you want to understand the chain reaction that followed, that's the signal to focus on. Because for the first time in nearly a month, ETF demand didn't just slow down, it reversed. And when ETFs reverse, everything changes. For the past year, ETF inflows have been the stabilizing force behind Bitcoin. Every morning, US desks opened with predictable buy-side support, tens of millions flowing in, sometimes hundreds of millions. That demand didn't push price higher directly, but it created a floor, a buffer, a layer of liquidity that absorbed selling pressure and allowed the market to build structure. But when ETFs flip into outflows, that buffer disappears. Suddenly there's no stabilizing force, no predictable buyer. And in a holiday week, when liquidity is already thin, the absence of that buying power becomes a vacuum. So as tech stocks fell, ETF outflows accelerated. As ETF outflows accelerated, Bitcoin drifted lower. And as Bitcoin drifted lower, leveraged traders started hitting liquidation levels. Once liquidations begin, they trigger more liquidations. And because liquidity was so thin, each liquidation moved price more aggressively than it normally would. It wasn't a fundamental rejection of Bitcoin. It wasn't a loss of confidence. It was a mechanically driven cascade amplified by the weakest liquidity conditions of the month. Now this is where a lot of people get confused, because from the outside, it looks dramatic. It looks like the market changed direction. It looks like sentiment died. But underneath the surface, something important is happening. Long-term holders didn't sell. Whales didn't dump. Exchange reserves didn't spike. Smart money accumulation didn't stop. None of the deep structural metrics showed fear. And that tells us something crucial. The market wasn't reacting to fundamentals. It was reacting to mechanics. Now, this is where people ask the big question. If this wasn't a structural breakdown, then why did it feel so violent? Why did altcoins move the way they did? Why did sentiment collapse? And why does it look so much worse on the surface than it actually is? The answer is simple. Markets react emotionally. People react emotionally. And social media amplifies that emotion tenfold. But markets that are driven by mechanics, not fundamentals, recover quicker than people expect. Liquidation cascades end the moment leverage resets. ETF outflows can reverse in a single session. Tech stocks correct quickly and often bounce just as fast. And liquidity returns the moment US traders come back online. Think back to every major shakeout in previous cycles. The most violent drops always happen during thin liquidity periods. Christmas Eve, New Year's week, Easter weekend, Thanksgiving, times when the majority of the market wasn't watching. Every time, people assumed it was the start of something catastrophic. And every time, the market recovered faster than sentiment did. This move has all the hallmarks of the same pattern. But here's the part that really matters. What does this mean for your portfolio? What does it mean for the market heading into December? And what does it mean for early 2025? The answer depends on how you look at the situation. If you look at the drop in isolation, the red candles, the liquidations, the panic, it looks negative. But if you look at the factors behind the drop, ETF flows, tech weakness, thin liquidity, it becomes clear that nothing about the long-term picture has changed. In fact, if anything, this drop resets the market. It flushes out irresponsible leverage. It clears out froth. It puts the market back into the hands of long-term holders. And it sets the stage for a cleaner move higher once liquidity returns. And that's exactly what we're seeing right now. This is where we need to stop and bring some reassurance, because a lot of people listening right now are frustrated. They're tired of seeing drops. They're tired of volatility. They're tired of sideways movement. They're tired of feeling like the market teases a recovery and then hits them with a pullback. And I get it. Everyone gets it. That emotional fatigue is real. But crypto cycles don't reward impatience. They reward conviction. They reward perspective. They reward the people who stay focused during periods exactly like this. And here's the good news. Yes, actual good news. Hidden beneath the noise. Nothing about the bigger cycle has changed. Rate cuts are still coming. Liquidity conditions are still expected to loosen. Institutional demand is still building. Crypto adoption is still accelerating. Regulatory clarity is improving. And supply tightening is getting stronger. All of the long-term signals that matter, the ones that shape the next 6, 12, 18 months, are still intact. This drop didn't erase any of that. Now, let's talk about opportunity. Not hype, not FOMO, not reckless decision-making, but opportunity that emerges from a move like this. Because one of the hardest lessons in crypto is learning that the best opportunities rarely feel good when they appear. They feel uncomfortable. They feel messy. They feel uncertain. And they show up when people are tired, frustrated, or scared. But if you missed the last buying opportunity, if you watched Bitcoin dip into the 80s and hesitated, if you told yourself you'd get in on the next pullback, This may be the moment you were waiting for, if you use a calm, sensible strategy. Not all in, not YOLO, not emotional trading, but measured, patient, consistent investing. Because dips created by mechanics, not fundamentals, tend to be the healthiest dips of the cycle. And there's another piece of good news. ETF outflows rarely last long. In fact, in previous cycles, ETF outflow streaks reversed within days. All it takes is one strong session of inflows to flip the entire narrative back to positive. And when inflows return, they don't just restore stability, they reintroduce the upward pressure that's been driving Bitcoin all year. And let's not forget something important. Institutional investors haven't left. They didn't abandon ETFs. They didn't dump exposure. Most of the outflows this week came from short-term tactical positions, not long-term asset allocators. That distinction matters because it means the foundation underpinning this market is still there. Meanwhile, tech stocks, which contributed massively to this drop, are already showing signs of stabilizing. And history tells us that once tech finds its footing again, crypto tends to be one of the first assets to rebound. So where does that leave us? It leaves us in a moment of reset, a moment of clarity, a moment where the noise is louder than the reality, a moment where emotional reactions will separate the people who build long-term wealth from those who get shaken out. And if you're listening to this, it means you care enough to stay informed. You care enough to understand what's really happening underneath the surface. And that alone puts you ahead of the majority of the market. So as we close out today's deep dive, remember this. The market hasn't turned bearish. It hasn't entered a new downtrend. It hasn't rejected the cycle. It experienced a mechanically amplified pullback triggered by ETF outflows, tech weakness, and thin holiday liquidity. That's it. Nothing more. And as always, perspective is your most powerful tool. The people who can stay calm in moments like this are the ones who thrive when the next expansion hits. And it will hit. So stay grounded, stay focused, stay smart with your moves, and keep your eyes on the bigger picture. If you're enjoying these deep dives, rate the show 5 stars, drop a comment saying "done" for the Friday XRP giveaway, and share the episode with someone who needs some clarity today. We're building something special here, and your support genuinely means everything. And like always, we'll see you at the top.